Imagine growing your wealth, not through a magic money tree, but with a financial tool that works while you sleep. Yes, you heard it right. This tool is none other than mutual funds. It's like a potluck party, where everyone brings something to the table. In the case of mutual funds, this something is money, of course. Different investors pool their money together, and this collective amount is then used to invest in a variety of assets. And what's even more exciting is that you don't have to be a financial whiz to invest in mutual funds. Mutual funds are managed by professionals who are aptly called fund managers. These fund managers are like the chefs at our potluck party. They decide what to cook, or in financial terms, where to invest the pooled money. They do the research, make decisions, and manage the investments, all with the aim of getting the best possible returns. Now, you might be wondering, can these mutual funds cater to my specific goals? Well, the answer is a resounding yes. Whether you're saving for a new home, your child's education, or your retirement, there's a mutual fund out there that's got you covered. And it doesn't stop there. Mutual funds also cater to different risk tolerances. If you're someone who likes to play it safe, there are mutual funds that invest primarily in debt securities. But if you're a bit of a daredevil and don't mind taking risks for higher returns, there are equity-oriented funds. And for those who like a bit of both, there are hybrid funds. So in a nutshell, mutual funds are not just a one-size-fits-all kind of investment. They offer a wide range of options to cater to different investment goals, risk tolerance levels, and time horizons. So, mutual funds are like your personal finance managers, working tirelessly to grow your wealth. And the best part? They work while you sleep. So sit back, relax, and let your money work for you. Now that you know what mutual funds are, let's delve into their different types. Firstly, we have equity funds. Picture equity funds as the thrill seekers of the mutual fund family. They primarily invest in stocks and aim for high returns. But with great potential returns comes greater risk. These funds are best suited for the adventurous investor who doesn't mind a roller coaster ride in the pursuit of higher returns. Next up are debt funds. Unlike their thrill-seeking cousins, debt funds are more like the steady tortoises of the mutual fund world. They primarily invest in fixed-income securities such as bonds and treasury bills. The aim here is to provide stable and predictable returns, making them ideal for the cautious investor who prefers a smoother, less risky journey. Then there are hybrid funds, the chameleons of the mutual fund family. They invest in a mix of equities and debt, offering a balance of risk and reward. If you're the type of investor who likes both the thrill of the roller coaster and the steadiness of the tortoise, hybrid funds might be your cup of tea. But let's not forget about the other members of the mutual fund family. There are sector funds that focus on specific industries, index funds that mimic the performance of a particular index, and money market funds that invest in short-term debt instruments, to name a few. Each of these has its own unique characteristics, benefits, and risks. Choosing the right mutual fund type is like choosing your favorite ice cream flavor. Some might prefer the exciting taste of Rocky Road, while others might be more comfortable with the classic vanilla. It's all about understanding your taste buds, or in this case, your risk tolerance, investment objectives, and time horizon. Remember, each mutual fund type comes with its unique flavor and risk profile. So make sure to pick the one that best suits your palate or investment appetite. Investing without a goal is like traveling without a map. You might reach somewhere, but is it where you wanted to go? Let's delve into the world of goal-based investing. It's all about aligning your financial aspirations with the right types of mutual funds. It's about making your money work for you in a way that brings you closer to your dreams, be it a comfortable retirement, your child's higher education, or even that dream home you've always wanted. Now, you might be wondering, how can different mutual funds align with different financial goals? Well, let's break it down. Say you're looking at a long-term goal, like retirement. Equity funds, with their potential for high returns over the long run, could be your best bet. They invest primarily in stocks, and while they may fluctuate more in the short term, they've historically provided solid returns over longer periods. On the other hand, if you're saving for your child's education in the next 10 to 15 years, a balanced or hybrid fund might be the way to go. These funds invest in a mix of equities and fixed income securities, aiming to provide growth and income while mitigating the risk of market volatility. For short-term goals, like saving for a down payment on a house in the next 5 years, debt funds could be the perfect fit. They invest in fixed income securities like corporate bonds and government securities, offering stability and regular income. But remember, mutual funds are not a one-size-fits-all solution. Each type of fund carries its own level of risk and potential for returns. Your choice should factor in your risk tolerance, investment horizon, and the nature of your financial goal. And there's more to goal-based investing than just picking the right fund. It's also about investing the right amount, at the right time, and staying the course despite market ups and downs. So, when it comes to mutual funds, remember this: your investment journey should be tailored to your destination. That's the beauty of mutual funds. They offer a variety of options to cater to your unique financial goals. With mutual funds, you can tailor your investment journey to your destination. What if I told you there's a way to save tax and grow your wealth simultaneously? Enter the Equity-Linked Savings Scheme, or ELSAS for short. This type of mutual fund is a superhero in disguise. It not only helps you save on taxes under Section 80C of the Income Tax Act, but also gives your money the potential to grow over time, thanks to its investment in the equity market. ELSAS funds have a lock-in period of 3 years, which is the shortest among the tax-saving investments in India. This means, after 3 years, you have the freedom to withdraw your investment or continue to let it grow. But remember, the equity market can be a roller coaster ride. It's thrilling, but also unpredictable. So, while ELSS funds have the potential for high returns, they also come with higher risk. So if you're looking for a tax-saving tool that can also help grow your wealth, ELSS could be your answer. ELSS, the superhero of mutual funds, saves your tax and builds your wealth. Investing in mutual funds is not a sprint, but a marathon. And like any marathon, it's not just about the start or the finish, but the journey in between. And that journey, dear friends, often calls for regular review and adjustments in your mutual fund portfolio. Think of it like this: your mutual fund portfolio is a garden. You've planted a variety of seeds, equity, debt, hybrid funds, and so on, each with their unique growth patterns and yields. Now, you wouldn't just plant the seeds and forget about it, would you? No, you'd water them, prune them, and maybe even change their location based on sunlight and seasons. Similarly, your mutual fund portfolio needs your attention and care. Market conditions, for instance, can influence the growth of your investments. A bull market could mean your equity funds are blooming, while a bear market might see them wilting. Being aware of these conditions helps you make timely decisions, like rebalancing your portfolio or altering your investment strategy. Then there's the evolution of your personal finance goals. Maybe you started investing with the idea of buying a house in 10 years, but now, 5 years down the line, you've decided you'd rather travel the world. Such a significant shift in your financial objectives might necessitate a change in your mutual fund portfolio. Risk tolerance is another factor that can change over time. As a young investor, you might have been comfortable taking on higher risk for potentially higher returns. But as you grow older, you might prefer to shift towards more conservative investments. Remember, making changes to your portfolio isn't about chasing the best fund or trying to beat the market. It's about ensuring your portfolio continues to align with your financial goals and risk tolerance. It's about making sure your investments are working for you, not the other way around. So, do yourself a favor. Regularly review your mutual fund portfolio. Understand the changes in your life and in the market, and make adjustments accordingly. Reviewing your mutual fund portfolio is like tuning your car engine for optimum performance. Because after all, who doesn't want a smooth, successful ride on the road to financial freedom? Now that you're equipped with the basics of mutual funds, what's next? We often ask ourselves this question when we're ready to take the next leap, don't we? Well, the answer is, it's time to deep dive. It's time to explore further, to consult a financial advisor or immerse yourself in more research to make informed decisions. Remember, mutual funds are not a one-size-fits-all solution. What works for one may not work for another. Why? Because we all have different financial goals, different risk tolerance levels, and different investment horizons. So, understanding these aspects is absolutely crucial before you invest your hard-earned money. It's like embarking on a journey. You need to know your destination, the risks involved, and the time you have at your disposal. So take your time, understand your needs, and then make your move. Your journey into the world of mutual funds begins now. Explore, learn, and grow your wealth.